when we look at China's leverage, I wouldn't describe their trillion. They have roughly $1 trillion in U.S. Treasuries, more or less. We can remember that back in March 2020, during the COVID crash, there was an issue where foreigners started selling treasuries, so the treasury market broke alongside the stock market, which was unusual because normally when the stock market's going down that much, people flee into the relative safe haven of treasuries. And at first, people were doing that until it got so bad that the foreign sector and risk parity funds had to kind of unwind in a disorderly way. And when that happened, the Fed came in and bought $1 trillion of treasuries in 3 weeks. They ended up doing multiple trillions of dollars in total QE. And so compared to China's, ability to sell up to $1 trillion in treasuries, I think that's something that could be absorbed. But I think that there are much bigger risks, between these two countries. One is that much like how Russia had their reserves, frozen, China is actually vulnerable to having their reserves frozen. So that's a risk on their side. A risk on our side is that China can, nationalize a lot of our companies' manufacturing facilities or otherwise cut us off. And that's a much bigger problem than just selling, half or all of their treasury stash in kind of a disorderly way. So I think Luke Groban described it well, a fellow analyst. He pointed out that, Lehman was like a $600 billion balance sheet, whereas China, it's like a multiple tens of trillions of dollar balance sheet. So basically, the interlinkage between these two countries is so great that they have very significant ways to hurt each other, even more so than some of the ways that Russia and Europe, for example, have ways to hurt each other. Partially how high it goes, and it's also partially the speed with which it gets there, right? So if the dollar kind of grinds up slowly over time, it can get to a higher level without breaking things compared to if it just shoots straight up, which is what it did during that COVID crash. That's what triggered the foreign sector having to sell it. Because, if you look at foreign balance sheets, they have something like $13 trillion in dollar-denominated debt, according to the Bank for International Settlements. That's mostly not owed to the U.S. It's like owed to other foreign entities. So countries in Africa owe China. Countries in South America and Turkey, they might owe European entities, right? It varies across the world, but it's denominated in dollars. And so if you have a situation where dollar-based cash flows are drying up while they still have all that debt, they have a problem. But one of the things that they can do is, the foreign sector has tens of trillions of dollars worth of U.S. assets. That includes stocks, treasuries, corporate bonds, and less liquid U.S. real estate. And so the entities that have those types of assets can sell those assets if they ever need dollars. And that's what we saw in that kind of March 2020 environment. And obviously some emerging markets are in better shape than others. So for example, Turkey's in a very rough spot because they have liabilities that exceed their assets in terms of international reserves. Whereas when you look at, a country like Brazil, they're in somewhat better shape, for example, and so they have more options available to defend their currency. We're also seeing, if you look at the dollar index, as strong as it has been lately, it's actually been more a factor of how weak the euro and the yen are. If you look at the dollar compared to a lot of other major currencies, it's been strengthening, but in many cases it's still below the highs it reached in 2020. Whereas, when you compare it to the euro or yen, that's a different story. It's kind of broken out against those. So I think that this particular dollar rally has not been as vicious on emerging markets as it could have been. But if it keeps grinding up, and especially if it goes up in a disorderly, quick way, that can absolutely put pressure on, especially the weaker emerging markets, the ones that have more debt than they have, international reserves. So Turkey's at risk, Chile's at risk. Argentina's at risk. Basically, there are a lot of these periphery countries, whereas I think other countries like China, Brazil, and places like that, they have somewhat more resiliency because they have significant reserves to offset their liabilities. Well, I think so. There's always a challenge in trying to determine tops and bottoms for anyone. I generally use kind of a dial in and dial out approach, meaning that if the market goes down significantly and sentiment turns very bearish and valuations improve, I generally put a little bit more chips on the table. I buy a little bit more equities. On the other hand, if we see a huge rally and kind of a euphoric peak, I trim some of my equities and get a little bit more defensive. And it's not necessarily that I'm trying to time the top or bottom specifically, but it's rather that I'm just risk managing and kind of allocating around the margins. And so the first half of this decline was mainly valuations. So earnings were still holding up well, but as interest rates rose very quickly, we saw downward pressure on a lot of valuations for different equities. The second half of the year, I think the bigger risk is the earnings side. And so we've seen somewhat of a relief rally here as forward expectations of interest rates have cooled off. So that takes some of the pressure off of the valuation changes. But I think the key risk to watch going forward is earnings weakness. And I'm very kind of sector dependent. And so, for example, I think that there are energy pipelines, there are healthcare stocks, there are value-oriented, dividend-oriented equities out there that are trading at average or historically below average valuations, even as the broad market is rather expensive. And so I think it comes down to, it could come down to individual stock selection or sector focus. Basically, I do think there are opportunities out there, but I think that, I'm kind of modeling this more like a wide band of volatility rather than kind of just a steep fall, right? Because we still have high inflation, we still have negative real interest rates, so it makes it challenging for investors to get too focused on bonds and cash. But I do think that there is another risk of another leg lower, specifically from the earnings side. So that's what I would watch is signs of earnings deterioration from major companies. So I always have some cash equivalents and kind of those types of defensive assets. And like I said before, I kind of dial it in and dial it out a little bit based on market conditions. So I never go all to cash. I never drop my cash to zero. But instead, if we have if equities are down, 20%, and then there's some kind of, particular names that are down 40, 50%, but I think that are high quality, I then might take some of my cash and just kind of lean in a little bit to some of those things that fell quite a bit. I've done a little bit of that this year. Whereas when you see the opposite, when you see like a huge euphoric spike, I try to use that opportunity to take a couple chips off the table and build up my cash levels a little bit. So it's less about trading and it's more about rebalancing and position management and kind of leaning in a slightly contrarian way, kind of the opposite of what the market's doing. So it's really challenging because there's human decisions involved, right? So that partially how it plays out, it depends on what Putin does, and then it also depends on what European leaders do. But I think in general, they're going to resort to more diversified energy sources, burning more coal, burning oil for electrical energy, which is generally not what you want to be doing, but it's something you can do in an emergency, and getting more LNG, and so that can put higher pressure over time on energy prices globally. I mean, if they're basically buying oil to try to fill some of the gap they have from natural gas, that puts upward pressure on global oil markets, and they're more fungible than natural gas. One of the reasons that natural gas can get such crazy prices over in Europe is because, unlike many other commodities, it's not very fungible. So, things like copper and oil are their prices vary somewhat around the world, but it's actually a pretty narrow band for the most part because it's usually not that hard to ship those things to where they need to be. Natural gas is a lot more challenging because in order to transport it long distances, you either need a pipeline, which obviously requires years of construction and a lot of capital expenditure and needs to be over land usually, or they can do LNG, liquefied natural gas, but the problem there is that the fleet is only so big and the facilities that are required, it's a very complicated process. You have to hypercool it and liquefy it, transport it, and then reverse the process, and that's a very expensive and limited capacity thing to do. So there's only so much LNG available at any given time, and so it's actually much harder to kind of close these price gaps for natural gas compared to just about any other commodity. And so I think that basically the upward pressure that they're going to do is that by resorting to other commodities, especially oil and coal, it puts pressure on those markets. So I think it kind of ripples through the whole world in that sense.